Okay, hey everyone. We're just waiting for Rizwan from Equitable Bank to join us at the meeting. Um, Today he'll be going over his A-side lending and B-side lending. So if you'd like, could you please have your lender spotlight open, and you can filter by lender if you like, and you can just sort of have some intel about what rates are currently offered by Equitable, also which products are currently available through Equitable. Remember that they do have an alternate division. Usually, if you've brought me a file that's self-employed or has a high TDS, um, sometimes the lower credit scores as well, we send those to Equitable quite often. So the alternate side is, I'm assuming, where most of you will have questions. Feel free to ask any questions that you do have to Rizwan directly once he joins us. Um, there are actually three major product lines at Equitable. There is the A side, the B side, and there's also a reverse mortgage. So the reverse mortgage is actually one of the newest products on the market for Equitable. It pays a ridiculous amount. So on an upfront lump sum pull from a client on a reverse mortgage, so let's say they want to pull out 60, 70, 120K, depending on one, their age, and two, their property value, you will be paid 200 basis points, 200. So it's a really, really enticing reverse mortgage product. There is a website for the reverse mortgage. So use that as a calculator. Maybe I can share that right now while we wait for Rizwan. I'm going to have to follow up with him as well. Let me do that now. Oh, here he is. Okay. There we go. Hey, Rizwan, can you hear me? Oh, I'm just going to wait for your mic to come in. Hey, Rizwan, I can hear you now.
Hey, perfect. Sorry, man. It's just with these Zoom calls, you always got to test the mic and all that. So my apologies on that.
No worries, no worries. Glad to have you here. So everyone, this is Rizwan from Equitable Bank. Rizwan, we have about 10 agents here from Zolo today.
Okay.
And they're of varying tenure here at Zolo and also in the industry. So yeah, I leave the stage to you, and you are able to share your screen. So I'm going to stop my screen share now so that you can do that.
Right. Hold on, give me a second here. I just gotta see if I can pull this up here. Now, Maher, just did you want me to go over A and B or just specifically B? What did you want me to emphasize on?
We would, yeah, I would love for you to emphasize on the alternate side, on the B side. I think that would be where you would be seeing most of our business. And then,
Okay.
yeah, let's see if we have some time towards the end, because I think there may be a lot of questions on the alternate side. Maybe we can cover some of your A side as well.
Okay, let me see if I'm having any luck sharing the screen with you guys. Just give me a second here. So I'm just gonna pull up our generic presentation. Hold on. Are you guys able to see the screen?
Not yet.
Not yet. Give me a second here.
Okay, yes, now we
How's
are.
that? All right,
It's just,
perfect.
okay, there, that's perfect. Yep.
All right, so I'm just gonna play this. Are you guys able to see that? It's all good?
Yes. Yep.
Okay, perfect. All right, so I'll start off with our B program, and I'll just touch base on our A side, at the end of it. So, for those who don't know me, obviously, Mahir knows me. My name is Rezwan. I'm one of the regional business managers of Central Toronto. So the region that I cover essentially is where your office is located. So I cover anywhere from Etobicoke to the start of Scarborough, and I go as far north as 404 and Steeles as well. So it's a fairly big region. It doesn't matter I know everyone's working from home, so it doesn't really matter where you guys are. Definitely reach out to me because I base it off of the head office of where you guys are located, right? So just going forward, I'm going to go over three things. Obviously, what Equitable Bank is about, our niche products that we cater to, right? On the B side, and some value added programs at the end, and going from there. Just to give you a background on my end, so you guys are aware of my background. So I was an underwriter for about 10 years prior to this. I've been around the block. I was with the Home Trust, with AGF Trust, CIBC, PC Financial. So I've been around, and I do understand how the climate of lending has changed over the past few years as well too. So the great thing about reaching out to me is just with the history that I've had in this industry, I can help your team and you guys package your deals. Um, Now more important than ever, it's very important that how you present the deal with lenders, and that is always the key, is the initial presentation of the deal. I know in the past, prior to 2014, 2015, a lot of agents and brokers would just submit deals, leave it up to the underwriter to kind of figure out how to patch things together. That's no longer the case with all the lenders. All the lenders do require brokers and agents to package the deal properly before it's submitted. And if it's not packaged properly, it's not fair to the underwriters to do this work for you guys. Hence why I'm here to help you guys package these deals and to understand, right? And the more deals you guys get underneath your belt, you guys will be able to understand how to package specific deals, right? Um, so the way we work is just to give you an understanding of from deal inception to funding, how we organize ourselves to help you guys service your clients. So you guys have a dedicated regional business development manager, which is myself. As of right now, because you guys are starting out, ideally, eventually you guys are going to have designated underwriters and designated fulfillment officers. So just to give you a little bit of a background on how it works is once you submit the deal, and once again, I'm talking about the B side as well as A side. So this kind of reflects both. Once you guys submit the deal, the underwriter will review the file and will, if it's good to go, they'll issue pricing out via email. Now you take that email and you discuss it with the client, say, hey, these are the options the lender is presenting. And, after talking to the client, go back to the underwriter, say, hey, the client selected this, can you please issue a commitment? And they will issue a commitment. Now, turnaround time on that as of right now is 24, 48 hours for review. And then once you identify what term the client wants, it's maybe another 24, 48 hours from there. So, setting the right expectations. But that doesn't mean it's written in stone. Obviously, if you guys have rush deals, loop me in. We'll do our best to expedite them as fast as we can, right? Once the sign back is sent back in, it does go to our mortgage officers, and our mortgage officers will review the deal, with a finer tooth comb as far as income docs, down payment. And once all is good, they will package it up, send it off for final management approval. Once that is signed off, the deal goes to funding. So that's just to give you an idea as far as how things work on our end, right? Any questions on that? No? Okay, so we'll move on. So looking at our niche markets on the B side, right? So there's three niche markets that we look at. Okay, we look at business for self, right, which is pretty much our bread and butter right now on the B side. We look at investors, and when I say investors, I'm talking about clients with large portfolios. large rental portfolios that they already have, or they're looking to buy, additional rental properties. And lastly, what's always been there is, helping Canadians with less than stellar credit, get into mortgage products. So we'll look at that as well. So I'll break down each of those three niches in the following slides. And then if you, like I said, if any of you have any questions, just ask away, and we'll go from there. So the first one obviously is BFS, right? Self-employed. So we'll look at registered and non-registered businesses, right? Now, here's the kicker. What sets us aside from some of the other lenders is that our minimum self-employed requirement is 6 months, right? So your client only has to be self-employed for 6 months. If you get a client walking in the door saying, hey, I'm only self-employed for 1 year, Equitable Bank will do it on the B side because our minimum requirement is 6 months, right? So we'll look at registered and non-registered businesses as well. Now, the viability of income for both registered and non-registered, we'll look at it through bank statements, commission income letter, or contracts, right? Now, I know there's an item in here that says foreign BFS income considered, okay? I'll be honest with you, that's a tough sell with us. I know they have it in the presentation, but when it comes to non-resident income, right? So I just want to highlight that. What I mean by non-resident is Canadian citizens that work abroad, okay? We're not talking about foreign buyers here. Every one of our applicants or anyone that goes on our application has to have some sort of immigration status in Canada. Being married to a Canadian citizen doesn't count as immigration status. They have to officially either have a PR or work visa or Canadian citizen. Now, it's okay if they're working in a different country. We're okay with that. And that's who we consider non-res. Now, in regards to their income, if they're self-employed, we, especially given the current climate of COVID and coronavirus, we're not really entertaining any self-employed income from overseas, okay? If it's in the US, it's case by case, just because it's a lot easier to decipher some of the self-employed documents from the US rather than, if your client had owned a car insurance company in the Philippines, right? So, if it's outside of North America, we're probably not going to do it. But if it's within North America, self-employed, we will take a look at it case by case. The better.
Can I
Sorry?
interrupt one for
Yeah.
just a quick question? It's in regards to the rental income for properties overseas. Will that be the same case as well, like within North America?
Yes. Yeah. So, I'll get into that once we get into our investors and rentals. It does get a little bit complicated, and funny you asked me that because this morning I just got an inquiry where a client owns a rental property in Nigeria, right? And the challenge on those type of situations is he needs that rental income to service the deal. But what ends up happening is in Nigeria, they do it differently. They don't pay monthly rent. They pay annual rent upfront, right? So it's only one payment. Secondly, how can we establish that the property is free and clear, right? What kind of title search can we get from Nigeria proving that the property is free and clear? And that's where the challenge lies in those situations. Now, the partly good thing about this inquiry I got this morning is that he claims that rental income on his T1s here in Canada, right? So which is a little bit better, but the question still remains is how can we prove that that property is free and clear, right? We could probably get property tax documents and mortgage documents, but if the property is free and clear, how can we prove that? So as of right now, in regards to that inquiry, I went back to the agent's going back to the client to find out more information, right? So it's more of a TBD. We'll determine once we get the full information, right?
All right. Thank you.
So just touching base on foreign income again, look, if your client is salaried, all I need from you guys is a letter of employment, 2 or 3 pay stubs, and 90-day history from the bank account in that country showing income deposits, okay? And we'll utilize it. And basically income, you'll just convert it based on what country it is as far as currency. You can just convert it to Canadian and put that on the application. Now, I also want to highlight is set the right expectations with your clients, especially if you're utilizing income from overseas. We are still going to call to verify employment, right? So we still need the letter of employment. The challenge becomes is when you're dealing with, timing. For example, if you got a client in Dubai, it's daytime right now here, but it's nighttime there. So it's just, and in certain occupations in Dubai and UAE, they're government owned entities. So you got to actually send an email to the government, and it takes up to 2 to 3 weeks just to verify employment. So with those type of situations, I want you guys to set the right expectation with your clients and make sure it's not a quick close, because if it's a quick close, it's going to be highly impossible to verify employment within that short period of time. All right. So just keep that in mind. Other than that, just moving forward, new immigrants, limited credit score, under BFS program, we're okay. Gifted down payment, we're accepting. Now, ideally, the gifted down payment definition for us is gifted down payment from family members, right? So brother, sister, mother, grandparents is okay as well, right? So just keep that in mind. Now, one thing that I always get into in regards to gifted down payment is proof of down payment, right? So I'll keep it simple for you guys. Okay, any gifted down payment over 120,000, we will ask for the donor's bank statements. Okay, so keep that in mind. Now, anything less than 120K, we may not ask for the donor's bank statements. And the differentiating factor on that is whether if the property is owner occupied or a rental. Okay, so I'll give you an example. If we have a client that is buying an owner occupied home, they're putting 40,000 down, they're getting 80K gifted from a brother or a mother, right? In that situation, because the property is owner occupied, more than likely we're not going to ask for donors' bank statements. But if you flip the scenario and let's just say he's buying a rental property, now you got an 80K gift coming from a third party into an investment property, they may come back and ask for donors' bank statements. Okay. So just keep that in mind. Even though our threshold is 120K, anything over we ask for donor, anything less we don't, but it also depends on the occupancy of the property. Okay. So keep that in mind. Flexible GDS TDS. So on our B side, we are able to go up to 48 GDS TDS. We have one product, which I'll get into on this presentation as well, which allows us to go up to 80 GDS and TDS. So it's a great niche product. So I'll get into that, as the slides go on. Our max amortization across the board on the B side is 30-year amortization. And we obviously look at owner occupied and rentals. And large loans, we'll look at it. We don't have a cap on large loans. Ideally, just to highlight some high level points on large loans, look, anything over 2 or 2.5 million loan, if your client's self-employed, get the financials, right? Because of the size of the loan, they may want to see the financial healthiness of the company, right? But anything below 2 million, we could get it done utilizing bank statements. Right? Any questions on that, guys? All right. So just moving forward, who is considered business for self and what documents are required, right? So now this is specifically for registered business owners. Okay, your sole proprietor, your partnerships, your corporations. This is normally what we ask for. We ask for articles of incorporation or master business license, or 2 or 3 reference letters if the business is non-registered. So I'll give you an example. Let's just say the client is a dog walker. They consider themselves self-employed. They file taxes as self-employed. They're obviously not going to have a master business license or articles of incorporation. In that situation, we will ask for 2 or 3 reference letters from their clients just to validate the business. And obviously, just to put a high level overview on this, look, there's 2 things that we need to prove when a client is self-employed. Number 1, does the business exist? And number 2, the viability of income. How do we calculate income? So does the business exist? Is this example here, articles of incorporation, master business license, or 2 or 3 reference letters? Income is the bank statements that we utilize to essentially get the viability of income, okay? The self-declared letter is standard on all self-employed deals. It has the gross amount of the business, the expenses for the business, and the net. And the net is what we qualify the deal, right? So that is how we look at it. Any questions on this? All right. So the other thing I just want to highlight as well, I know it says minimum 3 months bank statements, but because of COVID right now, they're actually requesting 6 months. Okay. So that may change down the road, but for now, just keep in mind that it's minimum 6 months that you actually require for self-employed applicants right now. All right. Now, non-registered businesses, and this is an example that I was telling you, like your dog walker or your daycare provider. So 2 or 3 reference letters, obviously the self-declared income, and then obviously 6 months bank statements for these guys, right? Now, commission sales, which is this next slide, is a little bit differently. We look at it differently. Now, when we're doing that, so basically when we're using bank statements for a self-employed applicant to calculate the income, how we do it is we will look at the last 6 months, we will look at all the income deposits, and we annualize it. So you add up the income deposits for the last 6 months, multiply by 2, and this is where you have your gross amount, okay? Now, out of that gross amount, you would take away reasonable expenses for the business. It doesn't have to be exact according to what they claim to the government on their financials, but it has to be reasonable, okay? I had an example where a client annualized his bank statements, and he was a restaurant owner, and annualized to 400K gross, but he needed 395 to service the deal. And I think I mentioned this to Mahir when I met with him, this example as well. 5K is not enough to run a restaurant, right? There has to be some common sense as far as expenses as well. So keep that in mind, okay? Now, for commission sales, as this slide is representing, we look at it differently. All right, commission people will essentially just look at their year-to-date income, right? Whatever they've earned so far, plus any pending sales for 2020. Now, obviously, that's more specific to the industry they're working in. So, for example, realtors. If you're looking to do a mortgage for a realtor right now, because of COVID as well, what we're doing is we're just looking at year-to-date, whatever they earned from January until now, okay? Plus any pending sales for the rest of 2020. And that is what you would use to qualify the deal. Now, we will ask for last year's commission statement as well, too, just to highlight what the level of income was last year, right? Are they on par? Are they below? And so forth, right? But what we'll use is year to date. And that goes for financial planners, car salesmen, anyone that's pretty much on commission, all right? So we'll ask for a job letter. They'll have to fill out a letter, self-declared income. Now, obviously, commission statements, or they could even provide the bank statements in lieu of the commission statement to show what they're getting, right? Any questions on this? All right. So another, just breaking it down a little bit more, non-registered business, you get a lot of IT contractors or contract employees, okay? Now, these are diverse in nature. You may have a guy that's been in the industry for years, but hopped around to different companies, or a guy fresh into the industry, right? What we generally require is a copy of the contract, confirming taxes not deducted, and the income breakdown, right? Ideally, self-declared letter because they are self-employed, and then obviously bank statements for the validation of income. Now, specifically to contract employees, here's the bottom line. If they're fresh out of high school and it's their first contract and there's an expiry date on it and it's going to expire before the term is over, more than likely we'll ask them to have at least one renewal of that contract underneath their belt before we'll entertain the deal. Okay. But if it's a client that's been in the industry for 5-10 years and he's done contract work for many companies, we're okay with that. We'll still ask for a current contract and we'll use the face value of the income that's on the contract. All right. Moving forward. All right. Gratuity-based income, bartenders, waitresses. Look, given the current environment that we're in, this is a really tough business to be in right now. You know, with restaurants and everyone shutting down or cutting back hours. So at the end of the day, these type of employees, we're actually looking at them case by case. It all depends on who they're working for. Are their hours guaranteed, or if not guaranteed, you know, what have they made so far this year? So there's a lot of flexibility around here, but at the same time, we are kind of scrutinizing it a little bit more given the industry that they were in, right? So if you do get a bartender or a waiter, waitress that's in the service industry and that's highly affected by COVID, reach out to me and give me the specifics, and I'll tell you how to position it, or whether if we can do it or we can't. Okay. The next slide is actually our self-declared letter. So I'll give you guys an example of how it looks like. So up at the top, obviously the borrower's name, occupation, number of years self-employed, amount of employees, contact info. Stated income for the prior year. I know it says, you know, prior year, but generally you would just put this year's date on it. Gross revenue up at the top. Up there goes the essential annualized bank statements, what the gross amount is. Okay. And then below is just kind of like our predetermined expenses for a lot of the industries that are general. But you put in the expenses in there, and then you have the net operating income. And I have to advise that the net operating income is the income that we use to qualify the deal. Okay. Not the gross. It's always the net. So just keep that in mind. Any questions on this?
Yes, Rizwan, I have one.
Sure.
Stuff like I see a lot of people working with Uber or delivery services. Side hustles like that, where do they fit in?
Well, they're still considered self-employed, right? And what they'll do is, number one, they're going to look at the tenure, how long they've been doing it. So if you have an Uber driver or skip the dishes or whatever, and he's been doing it for 2-3 years, he has tenure in the industry. More than likely will use year to date, whatever they've earned so far, right? But an Uber driver that just started because he lost his job due to COVID and now he just started earning money, you know, it's the same situation. We'll probably just use year to date, whatever he's earned so far, right? I'll be honest with you, COVID threw a monkey wrench into a lot of this. In the past, what we were able to do is we were able to annualize the income, especially if they were driving Uber or skip the dishes for more than 2 years. We're able to at least get a snapshot of how they earned, income was earned last year. And then we could annualize the income using bank statements. But because of COVID, you know, and I know there's an uptick in Uber and skip the dishes now because a lot of people are, you know, at home, but they still want to make sure that makes sense, right? So I know it doesn't ideally answer your question, but they are looking at a case by case. And obviously they're here to make the deal work. They're not here to kill the deal, right? So once again, reach out to me if you get a one-off situation, you don't know how to position it. And if the year-to-date income doesn't work, reach out to me and we'll see what we can do on it. All right.
Right.
Okay, moving forward. So our next niche is, you know, investors, right? People that have rental properties, that want to buy rental properties. So this just kind of gives you an idea of how we look at our rental programs. It's not really a program, but this is how we look at rentals. So a couple things to highlight. If the property is owner occupied and also rental. So for example, if the client lives upstairs and the basement's rented, we will use 100% of the rental income. Okay, so it's 100% add back. Okay, now, and this is for subject and non-subject properties. Now, if the property is a full rental, right, subject or non-subject, we will use 80% rental offset. Okay. Mortgages under company names with personal guarantee, we're okay with it. And just to highlight that point, on our A side, we do not do any mortgages under company names. But on the B side, we're okay with it as long as all the guarantors of the company go on the application. So it could be an operating company or it could be a holding company. We're okay with that. All right. Now, as far as the type of property, so this is generally speaking, even if it's not a rental, if it's owner occupied, whatever it may be, on the B side, we'll look at a max of 4 doors. So a max of, 4 units within a home. Anything larger than 4 units will be considered commercial, and it will have to go to our commercial department. Now, on our A side, we do look at duplexes, triplexes, and fourplexes, but the major difference is they have to have retrofit status, right, with the government. If they don't have retrofit status, then you can't do it on the A side. Now, on the B side, we don't require it to have retrofit status, okay? But in order for it to be considered a unit, it has to be a self-contained unit. So a kitchen, bedroom, bathroom, and a separate entrance. Now, certain common entrances, we've gone around it, but just, if you have to walk in the house, go through the living room, kitchen, just to get to the unit downstairs, that's not really a separate entrance. Okay, so just keep that in mind. All right. The other thing I want to highlight is multiple rental units in a client's portfolio. We don't really care how many rental units or properties the client owns. As long as, you have to include it in servicing, as long as the rental offset makes a surplus and, the GDS, TDS is in line, we'll consider those. Now, we don't discriminate against the size of the client's portfolio, so just keep that in mind. Obviously, business for self clients are accepted under this, and fair market rents is required on every appraisal. So whenever you're dealing with rental income or rental property, especially on the subject, they will ask for fair market rents. Now, what has changed due to the current environment that we're in addition to fair market rents, they are, in order for them to consider using rental income, they want to see a lease agreement as well as, bank statements to show that the rent is being continued to pay. Rightfully so, because, during COVID, a lot of people got laid off and they couldn't pay rent. So we just want to make sure if we are going to be using rental income that there is tenants in there that are paying rent. You are going to get anomalies where the client is buying a property and it's vacant upon possession and there's no tenant in there. So how do we get a lease agreement? So ideally, we would prefer if you had a lease agreement in place right before you moved in. But if that's not the case, how we evaluate it is we look at how much of that rental income do we actually need to bring the servicing in line. So more than likely, if you need all the rents and there's no tenant in there, and you need all the market rents just to service the deal, more than likely they might shy away from it. But then, if the client is really, good, has a good profile, it's a good covenant, and, they can maintain this property without using market rents, we'll do those all day. Or even if you need a small fraction of these market rents to make the deal service, we'll also take a look at it. I think the deal breaker, given the current environment, is how much of that rental income do we actually need to service the deal? And that's a question you guys should ask when you guys are filling out these applications in the current environment that we're in. Now, will that change down the road? Obviously, once COVID is behind us and there's no lockdown or quarantine, but that's just how we're looking at rental income right now. Any questions on this?
Hey, Rizwan, just a quick question for you. In terms of GDS, TDS on rentals, is there a max that you look at for that?
It's still 48, GDS and TDS.
Okay. All right.
So that's across all our product lines. So whichever way you look at it, it's still max 48 GDS and TDS, but the amortization is max 30 years, with the exception of one product, which I'm still going to get into later on in this presentation, and then we'll go from there.
Perfect. We've actually had a lot of inquiries from out of province clients that have big rental portfolios. I'm talking Alberta and BC specifically. Are those areas that you would look at, even if not quite licensed yet?
So here's the thing. I mean, in order for you guys to facilitate this application and submit it, you have to be licensed in that province where the subject property is. If you're not, you would have to look at co-brokering it with someone that's actually licensed there. Now I know, with your platform that you guys have, you guys may know someone within the company that's registered, or someone that you guys could reach out to them. Now, as far as lending areas, Equitable Bank is national. We lend coast to coast. Obviously, there's certain areas, certain pockets that we don't lend in, like Northwest Territories, Nunavut, like those kind of areas we don't lend in. Calgary, we lend in major cities, across all the provinces. It's all about the major cities. And that's where our niche is. Ontario, for example, look, we'll go up to Huntsville, maybe not at 80% loan to value, but we'll go up to Huntsville. Anything north of Huntsville, when you look at Sunridge, North Bay, like those kind of areas, we don't lend there, right? And especially if the property is too rural, surrounded by farmland, we're probably not going to do that property. The best way to explain is Equitable Bank likes urban subdivision homes. Those type of properties will lend on all day, right? And when it comes to the marketability of the property, we're not going to lend on the best house on the street, and we're not going to lend on the worst house on the street, right? Obviously, we look at something in the middle, right? But then again, you get the anomalies. Like we've done 75 on a cottage waterfront in Muskoka, and we also look at the strength of the borrower as well. Like, if the client's super strong, we could, it's not solely the decision is made on the property. We'll also look at the client as well too, right? So it's a combination of things that we look at when it comes to, lending in specific areas. But in Ontario specifically, look, I mean, the major markets, will lend in, but speaking of Oshawa, we don't lend South Oshawa. We don't lend south of the 401. If you're talking about Hamilton, it'll be east of Victoria Street, or not Hamilton, Niagara Falls. We are lending east of Victoria Street. So we're staying away from the touristy area. Okay. Hamilton, obviously staying away from Barton, Canyon Street, the industrial area of Hamilton. But on the mountain, on Hamilton, we'll go 80% all day, right? If you're not sure what kind of LTV we would lend on in these areas, just shoot me an email with the address, and I'll be able to confirm with you what the max we could do. All I need to know is occupancy. Is it rental or is it owner occupied? Because it does have an effect on LTV, right? One other market I forgot to mention was Windsor. So we did open up in Windsor about a year ago, right? Before we weren't lending there, but now we opened up in Windsor, but it's still a little bit tight. Like we're not lending everywhere in Windsor. And if it's a rental fourplex, low value property, more than likely we're not going to do it. Right? But still run the address by me, and I could give you a definite answer on that. Right?
Perfect. Specifically, we had one scenario where a property had a coach house, so a unit above a garage. Would those cause any issues?
Wouldn't cause any issues, but it just once again depends on the location. Now, if you take that property, you put it in a rural setting, like well and septic will lend on. We have no issues with that. But it just depends on what's around the property. So if you take that property and you put it in a rural setting, naturally, if we could lend on it, we're not going to consider the coach house as added value to the appraisal. So the appraiser would have to take out any value that the coach house has, right? And having said that, even looking at land or acreage that the property has, our requirements on our appraisal, our value has to be just solely based on the appraisal plus 5 acres, nothing beyond that, right? Also, not including any outhouses, any barns, any shops that are on the property as well too, if we do lend on it, right? Now, it may be a house that's centrally located in the GTA that has a coach house on it. Similar situation. They may not add value to that, right? It's just house and the main house, the living area, and that's what they look at. All right.
Do you have any conditions on swimming pools?
No. I mean, as long as it's not falling apart, right? But so swimming pools is fine. Look, the best way to explain it is like you could have many different situations with the property as to it might be a concern, it might not be. The main thing what you look at is marketability, right? And what lenders look at is, how many people is this property marketable to, All right. That's why sometimes you could get like a $10 million property. Oh my God, it's a great deal. But you got to look at it from the lender's perspective. If we lend on this $10 million property, let's just say if the client doesn't pay, we have to turn around and sell this property. How many people could we truly sell this $10 million property to? Right? Might not be a lot. It's a smaller niche market that people could afford this kind of house, right? So that's the kind of mindset that you guys also have to think about when you're looking at properties as far as marketability. If the property is located, and has a swimming pool, that's fine. Like we have no issues with swimming pools as long as, it's up to date. The other thing I want to mention is appraisals specifically. If they identify any home repairs, more than likely we're okay with it. But if it's like foundation issues, your pool is falling apart, it's going to cost a lot, it's detrimental that you have to replace it ASAP. Those type of situations, after we get the appraisal in, the underwriter may come back to you and say, hey, we have to do a holdback because this has to be repaired or that has to be repaired. Minor issues, cosmetic issues, we normally don't have any issues with. It's always the major issues, right? So when you look at an appraisal, when you get an appraisal, we want to make sure all the appraisal comments, like if you guys haven't gotten a chance to go through an example of appraisal, please do, because it gives you a lot of insight and a lot of information. So what us as a lender look at on appraisals, obviously number one is value. Number two is the comparables. We want to make sure that the appraiser used the comparables within the vicinity of the property. Like, the property is located in Guelph, but we want to make sure you didn't go all the way to Scarborough to pick out a comp, right? Which doesn't make sense. But majority of the appraisers don't do that, but they have an idea. The other thing I also want to look at is what we look at is the condition of the property. And that's something that we emphasize on is the property good to average or if it's in fair condition, right? It identifies whether the roof's in good to average condition or is it fair, same interior, exterior. And that is what we look at. And if we see anywhere where it says fair, we want to make sure the appraiser has put comments as to why it's fair. It might be because it's just dated, which we're okay with it. But then if he says interior is fair because, this wall is missing, there's a kitchen missing or this and that, then in that situation, we might come back and say, hey, listen, we're not comfortable going 80% on this. We may be comfortable doing 65, or we may want to do a holdback because of the condition of the property, right? So that just kind of gives you an insight on how we look at appraisals when we get it, right? Any questions on that? No? Okay. So let's move on. So we have a rental that we just went over. So obviously the last niche that we also look at is clients with bad credit or imperfect credit. So we'll go as low as 500 beacon, right? But just keep in mind, we still may not go up to 80%. It all depends on the reason why they have bad credit. Now, what I suggest is, look, if your client has a credit score in the 500s, ask him, why did he miss this? Why did he miss that? Because these are the questions that the underwriter is going to ask you, right? Like, what's the reason for the bad credit, right? The hard stop on this for us is if they've had missed payments on any mortgages, okay? If they've had a M2, M3 on any of the mortgages, more than likely we're not going to lend to this person, right? But that's the first question you should be asking if a client approaches you with bad credit. Hey, how has your mortgage repayment been in the last 12 months? Have you paid A1? And then you get into the conversation about why the bad credit, right? Because it's all about knowing your client. You got to know what situation they're in. So this way you can present them with a better solution, right? Once you get into the nitty gritty and you find out why the bad credit, obviously reach out to me. I'll see if, if there's certain specific scenarios that, you're not sure if we could do or not, reach out to me. I could definitely help you out. Now, let's talk about bankruptcies and proposals. Okay. So bankruptcies and proposals, if the client is in a current bankruptcy, we're not going to entertain the deal. Okay. If the client is in an active consumer proposal, we will entertain the deal, but it's on the caveat that we pay out the proposal. Okay, either from the proceeds or if it's a purchase, then the client has to have the funds to pay out the proposal. But if the client says, no, I don't want to pay out the proposal, I want to continue making monthly payments on it, then unfortunately we might not be able to entertain that client, right? Unless the proposal is like minor, like if it's a $5,000 proposal and a $20 payment, then we don't care. But obviously if it's a significant dollar amount on the proposal, then more than likely we're not going to proceed if they don't want to pay it out, okay? So just give you a heads up. New immigrants with limited credit, look, it's not that they have bad credit, it's no credit. We'll still entertain clients, you know, and rate wise, you're probably looking at mid fours or early fours as far as the rate, right? Any questions on this? All right. So I know a lot of this stuff is not going to stick in your head right now. And I totally get it. It's a lot of information, but listen, just anytime you get a situation, even though we've gone over it right now, if you forget it, feel free to call me. I have no issues with that. All right. Let's get into the products. So look, we do offer adjustable rates on our B side as well, right? Purchasers refinance. It's offered in a 3 and a 5 year term, right? Basically the benefit of this product is to break the term. The penalty on it's quite cheap. First year, 5 months interest, second year, 4 months interest. Year 3 and 5 year, it's only 3 months interest. So rather than putting a client in an open term, you know, because you never know where they might want to sell the house or whatever, you might consider putting them in an adjustable rate, right? The other product that I want to highlight, which I was talking to you guys in the beginning, is the product that allows us to go up to 80% GDS TDS. Okay. It's a niche product. We call it the total worth product. Okay. So a couple of things to highlight. Now, this is not for rentals. Okay. It's for purchases and refinances, must be owner occupied. Okay. And the clients must have a job. Okay. It's not for pensioners or students either. Okay. Now the way it works is obviously there's no max loan amount. The way it works is it's broken up into 2 buckets. Okay. I know it's a lot of information here. It's a little bit confusing, but it's broken up into 2 buckets. Okay. On our regular programs on the B side, we'll go up to a max of 48 GDS and TDS. Now, if you get an applicant in the door and the income's not too strong and your GDS, TDS is a little bit higher than that, then they may be able to fit under this program. So the way it works is if the GDS, TDS is between 48 and 65, right? And they fit the criteria of owner occupied, you know, it's not a rental and they currently have a job, right? We could do it under this program, and all they have to provide proof of is that they have 25%. So if you look at where it says net worth required, in the first bucket between 48 GDS and TDS and 65, they have to provide proof that they have 25% of the mortgage amount in liquid assets. Okay. And when I say liquid assets, I mean cash in the bank, RSPs, GICs, stocks, bonds, you know, that is liquid assets, not assets in properties or equity in property. That doesn't count. Okay. So 25% of the mortgage amount. Now, the other thing I want to highlight, it's the mortgage amount, not the value of the property. So whatever mortgage amount they're requesting from us, they need to have 25% of that in liquid assets, in addition to the down payment, if it's a purchase. Okay. Now, if the GDS TDS is between 65 and 80, then the liquid asset requirement increases to 50%. So they need to provide us proof that they have 50% of the mortgage amount in liquid assets. Now, in the second bucket, the 65 to 80 GDS TDS, the LTV will be reduced to 65%. Okay. But in the first bucket, where they only need to provide proof of 25%, we could still go up to 80%. And there's no premiums either, right? In the second bucket, there is a 1/4 point premium and LTVs cut back to 65%. Okay. No gifted funds allowed. Okay. It's very simple. Look, if the money, liquid assets is an investment, We just need a 30-day snapshot of where it is and how much they have. Okay. If it's in the savings account or checking account, or if it's cash in the bank, they're just requiring 90-day history of it. All right. Any questions on this?
I think that's a great product, and I will ask those of us who are here to
Right.
please review the files that you have and see if any of your clients qualify for this particular program, because we have had a couple that I can think of off the top of my head.
Okay, perfect. And the other thing
On
is, sorry.
what interest rate we are looking for this product? Like,
So within the first bucket, we can still offer them 299, right? Which is our current rate right now. But within the second bucket, you're probably looking at rates starting at 2.25, or sorry, 3.25, right?
Okay.
So it's about a quarter point difference, right? But I just want to emphasize it's for owner occupied, income. They have to be working as well, right? So it's not like, they're sitting on a ton of cash with zero income, right? So they have to have a job, right? If they don't have a job, tell the client, go get a job for like 30 days so you get this deal done, and then they could quit afterwards, right? But they have to have a job, right? All right. And at the bottom, it says tier 1 and tier 2 properties. Okay. So that's our way of saying, listen, we're looking at GTA central areas. So your major urban centers like Richmond Hill, Vaughan, Oakville, Toronto, Mississauga. But if you're looking to do this in the Kawartha region, or, north of Barrie or somewhere rural, it's probably not going to happen. All right. Okay, so just moving forward, HELOCs. So I just want to remind you guys, we do have a HELOC option. I'm going to flip over to the next screen because we have 2 HELOC options. We do offer a HELOC product in first position as well as in second position. Okay, first position, a max of 500K to 65% loan to value. In second position, max to 80%. Now here's the kicker. This HELOC is only behind our own product. Okay, so our first mortgage. So we don't lend behind other lenders. So I just want to give you guys a highlight on that. But look, if you get a deal and your LTV is below 80 and they qualify for a HELOC, throw that in there. You guys get paid on it. And the client doesn't have to use it for you to get paid. It's just free money. If you have to do that 5, 10, 50 money with 150 sell the client.
Hey, Rizwan, just one sec. I think we have an audio issue. Just one sec. Can you hear us, Rizwan?
Yeah, I can.
Okay, great. I think it's fixed now. Go ahead.
Okay, perfect. Yeah, so as I was mentioning, HELOC is a great product. And look, we have Christmas around the corner, and this is where we always find where more people apply for these HELOCs because they want to buy Christmas gifts, they want to have money for their business and so forth. So don't underestimate the potential of this product. It may not pay you as much, but it's still money in your pocket, and it's still an option for your clients as well too, right? So just keep that in mind, right? The next is essentially finder's fee. I'll quickly go over it. We do offer 1 year, generally speaking, 50 beeps, 2 year 60, 3 year on the fixed rate. We offer 90, but on the adjustable, it's 75, and so forth. So I'm not going to go specifically through all the, finder's fee updates. What I do want to highlight is always keep in mind is to get the best rate from Equitable Bank, there is a 1% fee on our products, right? Now that 299 that I mentioned, there is a 1% fee. But if you get a client that's fee sensitive and that says, oh my God, the 1% is, a lot. Look, if the LTV is below 80%, you can always look at capping that 1% fee onto the mortgage so the client doesn't get a lot. So the client.
Hey, Rizwan, one sec. Sorry. Hey, I'm not quite sure what's going on. We were just having some really really scratchy audio there.
Okay. No worries. Are you guys able to hear me though?
Yeah.
Okay.
Hi guys. Can I just interrupt
sorry.
quickly? Rizwan, my name is Pierre. I have a client who has somewhat higher ratios. So he's well below the 48. But of course, I was looking at your product and mentioned the 1% fee. What is it you can do about it? Can you say that again, please?
Yeah. So what if the LTV is below 80%, right? And obviously to get the best rate, there is a 1% fee. What you could do is you could go back to the underwriter and ask them, hey, can we cap that 1% fee onto the mortgage? So what that means is that it's going to be absorbed on top of the mortgage where the client doesn't have to pay out of pocket. But that's only if we're sitting below 80% loan to value. Obviously, if we're lending on a property and we're at 80%, because of the B20 guidelines, we cannot exceed 80% loan to value. So if we're sitting at 80 and you want to cap the fee, we can't really do it because we're already at 80%, right?
So 79.9 will do though.
Yeah, depending on the loan amount, right? If that 1% doesn't exceed, 80% loan to value, we could always cap the fee.
Okay. All right. That's good to know. Thanks.
All right. But to that point, we also have no fee options as well, right? So if the client is fee sensitive, we could present them with no fee options, but I just want to give you guys a heads up that the rates are obviously a lot higher, sometimes a 1% higher than what they would get, right?
Yeah, no,
So,
he wouldn't want to go for that. He was already kind of a little bit hemming and hawing at the rates that are there, but
yeah, exactly. Yeah. And other than that, look, I mean, that's what I'm here for. So that's pretty much the end of my presentation. I just want to highlight, some of the key products and how we look at things. One thing I do want to mention to you guys is always, given the current environment that we're in, if you get a client walking in the door, right away ask them, has their income been impacted by COVID, right? I know, online businesses are taking off and, you guys have quite a few clients that are in that industry, so that should be fine. But just if you get a random truck driver or anyone that walks in the door, try to make it a standard question that you ask your clients, because all the lenders are going to be asking that, has, his income been affected by COVID, right? And if you're not sure how to present it to us, that's where I come in, right? Because I know my team, I know what kind of questions they're going to be asking. So if you're not sure what to put on the notes, what not to put on the notes, just, what you could do is just give me a call, give me a quick synopsis of the deal. I'll run it through with you guys, and then we'll go from there. The only ask I have is just give me full disclosure on it, right? Try to find out all the information, give me full disclosure on it, because if I don't know certain things and it's submitted one way and then something pops up, I can't really mitigate it then, right? And as I mentioned to you guys, it's all about the presentation and how you present it initially. What lenders and underwriters look at is if the story changes once the deal is in the door, that's where the red flags start popping up. Like if the down payment changes, it went from savings to gifted, or and there's no real rationalization as to why that happened, that's where the red flags pop up, and that's where they start asking more questions. So we got to make sure we present it properly from the get-go. All right. Other than that, yeah, sorry, go ahead.
Whoever was asking, go ahead. Sorry, I'm not sure if someone was asking a question there.
No, I guess not.
Okay. Okay. Sure. I'll just ask my question. So, regarding that question, you said if the down payment changes or if it moves from one account to another account, if the client is like cashing out investments or like sort of they have an RRSP loan or something, is that okay? That's
100%. 100%. So just on a high level, when you're dealing with RSPs, when they're cashing out the RSPs, it's not only the proof that how much money they have in RSPs, because you got to remember they get taxed, right? I think it's like 20 or 30%. So if you're saying the down payment's coming from RSPs, you got to understand that we're going to take away 30% of that for tax, right? Because that's what they're going to get charged. And like our underwriters, a lot of underwriters have been around the block. look, if the down payment changes from, savings to gifted or from a different account, I'm not saying we cannot do it. I'm just saying it has to make sense. So just make sure you're able to rationalize it. Ideally, I prefer, it doesn't change, but, sometimes clients change their mind. They'll say, hey, listen, I had 15K in savings. I don't want to use that. My mom's, decided to step up and give me 30K. So I'm going to use that. That's fine, right? As long as it makes sense, right? But the reason why I said they're going to ask more questions is because now, if the down payment changes, the way they underwrite these deals is now they have to rationalize that and mitigate that, because the initial application came in as savings, but now it's changing to gifted. So they're not trying to make your life harder. Now they have to mitigate this application saying, why did that change? Because it has to do with the regulators, right? So just keep that in mind, right?
Awesome, thank you.
No problem. The only ask I have, Meher, once we get off this call, if you could send me kind of like a master list of your agents' emails, addresses, as well as yours, I'm going to get everyone added on to our mailing list. Now, this is for our A, B side, as well as reverse mortgages. So any pricing updates, anything that changes, I will blast it out to your team. So you guys have that. But today specifically, what I'll do is I'll send you guys some useful tools, right? That will help you guys package deals. I have kind of like a little cheat sheet on what kind of notes to put on a file. I'll also attach our income annualization calculator. So when you're evaluating income on bank statements, it makes your life a lot easier. I'll attach our rental worksheet as well too, which is for clients with multiple rental properties. So just kind of like a client consent form. Oh, by the way, we do pay on renewals, right? All you need to do is send in a client consent form. And if the client doesn't refi or go to another lender and they just want to renew with us, it's easy money for you guys. We still pay you guys on renewals, even though if you're just facilitating this renewal and all you need is a signature from the client. All I need from you is a client consent form, which I'll attach to that email as well. And that's it. All right.
Awesome, thanks. Yes, just for future reference, all of our agents are, you can reach all of our agents by emailing mortgageagents@zolo.ca. I just sent you that email address as well.
Okay, perfect. Yeah, so I'll blast it out. Give me till end of day. I got to catch up on some emails. I know it's month end, a lot of closing. So I'll blast it out before end of day. If you guys have any questions, just reach out to me, shoot me an email, and we'll go from there. And Meher, I was wondering maybe down the road, maybe next month, we could set up a presentation on maybe the reverse mortgage as well too, if you guys are interested in it. And,
yeah, we were just speaking about that product right before you joined. I think it's a great idea. And by next month, we should be adding about 10 further agents to the meetings. So
perfect.
We'll do that. We'll do it that way.
Awesome.
So I have one question, the last question. My name is Alex Rezwan. About the annualization for the registered business, because sometimes they're asking for 2 years. For example, the business is 3 years established. They're asking sometimes 2 years business sales, combining, dividing by 2. And now, right now, some underwriter, they're talking 6 months sales, and for sure that the multiply and just annualization of the income. Which way is correct way? Because honestly, it's very important for us to pre-qualify the client based off the income. That has happened to me even with the underwriter with the Equitable bank. What is exactly is this situation?
I think what you have to identify first is, are you submitting this deal on the A side or are you submitting this
B
deal
side?
on the
I'm talking
B
B side. Actually, it happened like 2 months ago in the B side, Equitable bank.
And they asked you for 2 years bank statements?
No, actually, yes, they asked me first. That's why I already sent them. And then I already calculate this way because before lockdown, this client, they have a very good sales. It's a registered business, everything. And during the lockdown, 4 months, for sure, they don't have the same sales. But the underwriter calculate different way. That's why we wasn't able to get this deal.
So here's the thing, and this is the reason why, right? So generally, we're asking for 6 months, right? You could even expand the scope. you could even do nine or 10 months. You could go from January until end of October now, because we're there, and you could annualize it. The challenge being is because of COVID, right? And because of COVID, there was, a lot of people that were off, that were collecting the benefits that weren't working. So the reason for this is my assumption. The reason why the underwriter was probably asking for previous year's bank statements, because they want to highlight how the client was doing prior to COVID, right? Now, let me guess, was this deal around the time that COVID was happening, the first wave?
No,
When did you?
it was in August. Now the point is, even they didn't calculate for 2 years. That's what my problem was. Because
No.
if the calculating for 2 years was perfect, because these guys have around $190,000 sales, right?
No,
but when the calculating
yeah.
during this 6 months,
Yeah.
for sure it's be like 120 income. That's why I want to make sure, for sure, we are getting more client. And if you want to go for 6 months period, for sure, for lockdown, might be they have some issue. They don't have the same sales. And I want to make sure which way we have to calculate. The correct way, we don't want to waste actually the underwriter time.
So I'll be honest with you. There's no black and white correct way of calculating it. Okay. Ideally, with us on the B side, we want to find out how their income looks like in 2020. Okay. The reason why they may be asking for previous years is just to put it in contrast on what they made last year versus what they're on par to make this year. So to your question, there's no black and white where I could tell you it's only 6 months or it's only 3 months, right?
6 months. Okay.
Yeah. So COVID threw a monkey wrench into everyone's program. If COVID wasn't there, I could tell you, Alex, it's only 3 months that we need. Our minimum requirement was only 3 months. We could annualize 3 months. If COVID wasn't there and income was, the economy was good, business was still open, I could tell you it's 3 months. It's because of COVID, they want to see a better picture of how their income is going to look like in 2020, right? So they're not going to do a 2-year average. It's more so they're concerned about 2020 and how their income is going to look like. What I'm telling my brokers is, look, you could do 6 months, right? But if you do 6 months, you're still touching base on some of the couple months in COVID during the first wave where they may have had 0 months of income. Mm-hmm. What you could do is do January until now, which is 10 months. It is going to include those months if they're affected by COVID, where they're going to have 0 months as well. And then you annualize it, right? That will give you a better picture of how their income is going to be in 2020, right? So it also depends on the industry as well, too, right? And where they work, what type of job they do. So I don't unfortunately have a black and white answer for you, but the best way I could explain is, look, try to get the best idea of what their income is going to be in 2020, right? Whether it be you're using 6 months income or even 10 months income, right? You have to, that's what you're trying to do. But at the end of the day, if you use 10 months income, you're annualizing over a longer period of time. So it may even cause your gross income to lower as well, right? On that note, I also want to make a comment on CERB and EI and the business benefit of 40K. So we are considering CERB, right? But you got to pick and choose. You can't use CERB as well as income, right? So either they're on CERB or they're not, right? If you see CERB deposits in their bank account when you're going through the documents, ask them, did you apply for it? Did you need it, right? It's okay, because the underwriter is going to ask, right? It's okay if they applied for it, they got it, but they, whatever, they never need it because the business is still continuing to operate. That's okay. We're not going to decline the deal because of that. Same thing with that 40K benefit that that self-employed applicants are getting. If they have it, now we're not going to use it as income, right? So just know that, right? And you cannot use that 40K. I actually had a agent trying to use that 40K benefit for a down payment on a property. You cannot use that because that benefit is to help maintain their business, right? So we're okay if they receive these benefits, but the underwriter's still going to ask why they received it, because the concern around is they want to make sure that their business or the source of income is still healthy, right? And there's still a good viability of income for the rest of the year. And that's the reason. So I know it's a long answer, Alex, but I can't give you a black and white answer because it has to really do specifically with the industry that the client's in. And, you know, I know underwriters are working hard to make these deals work, especially on my team, because they may be asking for more documents, but the whole key is they're trying to validate the income for 2020, right? But the standard right now, base it off of 6 months. If there's not enough income there, expand your scope to at least 10 months. So you're doing January until now, right?
Perfect. It means
All
the
right.
6 months is enough. If someone they have a 6 months good sales done, that's what we can analyze as the income.
Yeah, exactly. Now, also note, they will ask you, how was their income in last year? You can mention it. They're probably not, in certain cases, they're probably not going to ask proof of it. They just want to make sure they're on par to do the same thing as they did last year or more or less, right? But regardless, they're still going to use 6 months for the annualization of their income.
Perfect. Thank you. Thank you, Rizwan.
No problem.
Okay. So I think we should end it there, Rizwan. We're just a little bit over time here. Thank you so much for coming in.
No problem, no problem. So keep me posted, any questions, concerns you guys have, and we'll go from there. And expect my email to that email address by the end of the day, and we'll go from there.
Awesome. Sounds great. Thanks again.
All right. All right, guys. Have a great day.
Thank you.
Bye.
Bye-bye.